Welcome to Swimming with Allocators,
the VC podcast from the LP perspective,
with your hosts, Alexa Benz
and Ernest. You ready? Let's dive in. Welcome to episode 60, which means you're hearing a DDQ, discuss, debate, and answer questions from the audience, specifically just with Ernest and I. This is where we share what we're hearing from the LP community offline, so you get the full intel on what the community is sharing with us. That they're not necessarily comfortable recording. So the format again, DDQ, very cheeky. We're going to discuss what we've been hearing from LPs. Then we're going to debate some things that we haven't shared with each other previously, which I think is my favorite part. And then we're answering questions from you, the community. Anything to add, Ernest?
No, just welcome back. Alexa's been gone for a couple episodes that you'll probably see in the future too. But yeah, she didn't go anywhere. She just had a baby.
Thank you. It's nice to be here. Let's jump into the first D, discussion. The topic we wanted to talk about was what if the current IPO drought isn't temporary, but the new normal?
Yeah, and this is coming, we're recording this on a day that I saw a few friends post about some IPOs that recently happened. But when you look in comparison to previous years, it's still pretty sparse. And so, you know, this idea of what do exits and exit strategies look like for venture? Is this a new normal, or are we just going through a dry spell? And I think because of how long companies stay private, this is something that should be a real concern. And so we kind of have this perfect storm of companies are staying private a lot longer than they were in previous cycles. And we've had a lot of capital start to kind of freeze and not be deployed as fast as it was in a very, very fast deployment era. And we have an influx of new entrants in companies and verticals because, you know, we've had a technological shift with AI. So this has just caused a really cluster of how should we think about the risk reward when it comes to our asset class?
Yeah, the fact that some of the really the gorillas in the room, like Lightspeed and Sequoia, are all turning into more RIAs, allowing them to freely trade in equities and secondaries and roll-ups and even provide wealth management. Kind of is a signal to me that it feels almost like when founders just like add a slide on AI.
Yeah.
So if you went out to market and what you're offering is VC, things have been a little slow. VC has not been the trendy / comfortable / that's not where there's a lot of room to allocate additional dollars. So just be VC plus. Like stick an RIA on it, and then you can easily fill some additional buckets that the investment committees are going to approve.
It doesn't feel like VC at all.
Yeah.
And I've tried to make fetch happen by asking LPs, should this be a whole new category? It's not, it's private equity, in a sense, but not like LBOs, but it's not growth equity or venture as well. So should it be something totally new? I've been trying to, push equity buyouts because it's just a lot of equity going into these companies before they go public, but that's not really catching on. But when we think about how an allocator is assessing how to deploy from their portfolio, let's say that they are across all asset classes, both public and private. How do you start to think about venture? Should it be kind of classic venture firms, classic growth equity firms, and now these large RIAs? And then how should those be assessed? Like, what's the dispersion of performance now? What's the time to liquidity on all of them? And a lot of the conversations we've heard on these podcasts, as well as, off the record with different LPs, is you really need to decide what you're getting out of venture. Are you looking at getting venture alpha or coverage with venture beta?
Yep. No, I think that's a really important distinction, particularly because you're going to have different expected outcomes. If you're, are we actually aiming for 100x in a $25 million fund or a 2x in a $7 billion fund? The other thing this makes me think of from like a historical context, I question, the consolidation and the megafication of some of these big VC players as they metamorphosize. Will they be any good at it? So like Tiger, Coatue, Altimeter, they all tried to do these crossover funds where they were going earlier, and that didn't work out great.
Yeah.
So if you historically are an exceptional venture capitalist, and like venture capital, there's a lot of hot air. It's a lot of like dreaming big and shooting for the moon. Are you actually the guy who should be running some of these other strategies? And obviously you're going to build a team around you, but it feels almost like these are antithetical in their kind of like RIAs are fiduciaries. They're there to like help you avoid risk. Even private equity, these guys are cost cutters. They are brutal. They are, they're the hatchet men. And then you have the VCs, and they're the dreamers. They're the rock stars. So I just question that it's the right fit for the industry from just like a personality. Like is this what you really are great at?
I will push back a little bit on what they're doing. I think as you become bigger and you have more assets, you're going to be looking more for guaranteed wins per se.
Yeah.
And so this is why you see a lot of the same firms all in the same companies. And so if your approach is to provide coverage of what is going to be the breakouts when it comes to anything around technology and emerging technology, then you are playing a different game than what's going to be an outlier, right? You're trying to be, you're selling coverage of consensus. And by definition, then it's like, you're not really dreaming that big. You're dreaming big, but you're not really dreaming that big on finding what's non-consensus today, and then that's going to be consensus tomorrow.
Totally. It's a known universe of pre-IPO or never IPO businesses versus what a pre-seed or seed investor is looking at, which is really it's an infinite number of potential investments.
So actually, I would flip your question on like, are you not, instead of saying like, are you not prepared to move forward and expand into kind of like becoming a KKR or a version of that, I would say they're more prepared for that than going back to their old ways of being able to find those outliers, because you had so much success and now really defining what consensus is.
Yeah.
Another thing I wanted to discuss was, after the pandemic and we started having all these digital AGMs. And so now I think last year started really strong, but now we're fully into AGM season. And a friend of the pod, David Zhao, wrote a post saying that, AGMs are becoming diligence machines. It's a place where LPs really get a sense of where the strategy and execution of a firm strategy, how does it come to life? they do this by kind of talking to founders, figuring out what's going on. And they're not just talking to GPs. They're trying to connect the dots. Everyone's, calls them something else, but, they're still AGMs. They try to make them different flavors, but AGMs are a place where you really are able to show who you are and how your strategy comes to life. So I was wondering, what your thoughts were on this piece, how you think AGMs could really be leveraged, and what GPs kind of should be looking out for.
Totally. My favorite comment in this post was Indian wedding energy. Like, you're looking for social proof, and what more social proof than getting all these people in the room who co-invest with you or follow on to show the proof is that social proof. I do have an exceptional contractor who is in the industry and would be an incredible resource to anybody who wants to level up their AGM. She's not cheap, but I think there's real competition here to get people to attend. How are you going to justify a trip? Maybe you're linking it to a bigger event like Milken or something, but in general, I think they're like the expectation is to make these kind of special. That said, like, red flag if you clearly are out of budget or off, I guess, brand. I don't know how many of you all remember this, but the Silicon Valley episode where they're at what used to be the baseball stadium that
It's Oracle now.
It's Oracle now. Exactly. Yeah. Thank you. There was an AGM hosted there by the Rothenberg guys, and that ended up influencing, like, that was what they were kind of mocking in Silicon Valley, the HBO TV show. And that was an exceptional event. You're demoing with founders, like, as you're walking through the concessions, etc. But maybe a little more flashy than, like, really required. I feel like there's, like, a medium lane where people want to see, like, you take your job seriously and you're putting your resources toward the right things. But these certainly are an opportunity to stand out.
Yeah, I think that all GPs, when looking to plan an AGM, should think about how do they really put their own taste onto this typically normalized session. And you want people to leave away saying, that's the most Alexa AGM ever, or that's the most Earnest AGM ever. You want people to get a real sense of what your personality is. And then also, I think I've seen people like highlight founders. I've seen people highlight motivational speakers. I've seen people want to really highlight what's the network that's behind their firm's strategy that really provides the secret sauce. And I've even heard of people using it as an opportunity to highlight their network of friends that other LPs should consider. So having another GP spotlight. And that's really rare and says a lot about those specific firms that do that, because they're making space for others. So I think that's my first kind of tip for it, is make it interesting, but in a way that really reflects your firm's culture and who you are as a GP. The second thing I would say is, like, prep your junior staff and, founders, because this idea of them, of LPs grilling and asking questions really to everyone else,
I love this point.
Is real. Yeah. I remember being a junior VC or junior partner, and they're definitely looking for answers. So make sure that everyone's consistent in their statements, being genuine, but consistent in their statements, and not drinking too much. All right, so next we move into the second D, which is debate, where Alexa and I will present each a topic that we haven't shared with the other, and get their point of view. So hopefully there'll be some healthy debate here, which is we usually get from an enterprise and consumer VC coming together. So I'll start with one thing that I caught my eye over the last couple of weeks was VC Labs LP due diligence red flag list. And everyone should check this out, but it has just a flag overview of green flags, which are great things. So it show that emerging managers have promise and characteristics that could lead to strong performance. Yellow flags, which represent some minor issues that are common amongst first-time or second-time fund managers. Orange flags, which signify more significant problems that require careful consideration. And then red flags for Fund 1 and Fund 2 managers, they represent critical issues that should be seen seriously as a serious issue. So they have this whole thing where this is given out to the LP community and should be scored. And they suggest, no one should have 5 penalties. And so my question or my take on this is, although great to have as a framework, frameworks are meant to be broken when you're diligencing people, I will say. And, in the break, we were talking about this a little bit, but it was more applied to GPs, but it can be applied to LPs too. We're in an exceptions, not rule business where we're looking for exceptional individuals that are outliers, not things that if, assets or fund managers or businesses that if they follow these rules, then it will definitely produce this outlier result. That's just not how it happens. So I would say to allocators, yes, this is a great first framework, but our business, you have to trust your gut too. It has to be this balance between art and science. What are your thoughts on this?
I love this as a resource for GPs. I think for LPs, it's just a framework. The reason I think GPs need to look at things like this is so that they understand which parts of their package are kind of like the ugly duckling, what makes them an ugly duckling. As a GP, most VCs look for software, not hardware. Most VCs look for a technical co-founder. Most VCs are only going to co-invest with you in companies that are based on the coasts, right? So I think just knowing what's the equivalent of what are these things that LPs may discount you for, you've got to be familiar with that perspective. So that's why I think this list is so helpful. If you are fundraising yourself and you aren't great at thinking like an LP yet.
Yeah, I would agree. I would say with moderation, though, even for GPs, because I've seen a lot try to, use a framework like this or utilize what they've heard for 1 or 2 conversations with allocators and then have a rubric that they say, hey, I'm Teflon now. I am going to raise a lot of money. And that's just not the case always, because there's always exceptions as well of maybe they're already overweight in what you do. And so I push people not to look to, get the answers to the tests, but to create their own answers. This whole process of being a fund manager, building something from scratch, fundraising is not a standardized test. And sometimes we try to make that because we're humans and we like to have frameworks that help us deal with the abstract nature of the world, especially our kind of random industry. But this is more of an essay. And so think of it as all right, I have kind of what they're looking for, but I'm going to write it in, all right, here are my strengths. Here's what I'm good at. Acknowledge what you're working on to mitigate your weaknesses, but really honing in to what you're strong at and leveraging that. And I think when people try to talk about, as allocators, we're looking for differentiation. That's what they're looking for, is someone who's been extremely thoughtful and, hey, I understand and I'm learning more of how you think as an LP, but I'm not trying to just give you answers I think you want. I'm trying to craft the best essay that will appeal to you.
On this episode of Swimming with Allocators, I want to play a game, Start, Bench, Cut. And the topic I want to dig into is this retailization or democratization of access to VC. But what does that look like when it's actually a friend asking you what they should do with their money? So, Start, they have an option. This is a good friend. Maybe it's a high schooler. They are an accredited investor because of their own sweat and tears. Like, this is a gunner. This person's been working hard. And they run in great sort of network crowds, but not VC specifically. Yeah. So we're not talking about like podunk, but this would be their first VC investment.
Okay.
So one option, Start. They have heard of a mutual friend who is spinning out of a major firm, and they could put 100K in. There's like a big minimum to get in. This is like a no-brainer. Everybody's trying to get into this round, and they're coming to you saying, hey, sorry, not this round, this fund. They're asking you, would you do this? I only have 100K to put into venture. Should I give it to Rachel? Whatever.
Yeah.
Option 2 for Start, Bench, Cut is a new product that hasn't existed before. Hamilton Lane, OG alternative investments, now, like as of 2 weeks ago, has made a product that any accredited investor can get access to their portfolio of managers, specifically VC. And this hasn't existed before. And you now are getting all the benefit of all of their research. They're sort of indexing this for you. And it's liquid. You can get in and out. A lot less drama.
Okay.
Or option C, if you're only putting in 100K, what's the point? And you suggest that they pass. That there's plenty they can do with that 100K that is going to be a better fit for them.
And do they like know other assets? Like they have like, oh, I can put more in like Publix or something like that, right?
Exactly. Yep. They've been managing their own capital. They've been doing well. This is one of your smarter friends. And they're saying, if I'm going to participate in VC, how should I do it?
Wow, that's a great question. Those are all great options, to be quite honest. I think because they're first starting out, and if they have an interest of doing this more often, I would say, wait, one last clarifying. I can't split the money?
I think, let's say there's minimums.
Yeah,
I think
because
there's
it's minimums. Okay, cool. I would start the Hamilton Lane, given their experience, and it would give you some exposure, and hopefully they would have some like materials that you could receive as well, so you could understand, okay, these are the firms that they're investing in, these are the performance, and it's kind of I think we should have a return of like great fund to funds, given what we spoke about in the previous segment. And there's so much capital being concentrated in very, very big firms. And, by definition, those are turning a lot of deals into consensus faster. And so you're not going to have the rate of return, the outlier returns that you probably want. And so, one of the big reasons why, emerging manager programs are having trouble is because, if I'm raising a $300 million fund, some big pension fund can't put just 20 million. They need to put like 50, 75 million into a fund. And so I say that to say, I think there should be more capital put into fund of funds, especially experienced ones or ones that are taking an approach of, hey, we're really experienced in a certain asset class and we're going to provide you alpha. Second, I would do, I guess this would be bench. I would do the spin out fund. Because I host a venture podcast. I'm not going to tell you to go do private credit or publics. And so I make that bench instead of start because this friend is new. Like, unless I have some real information and I know that, let's say these 3 people or 4 people who came together are some real gunners and have a unique approach that makes them founder magnets. It's going to be about more them than anything else. Not that they came from tier 1 firms. I could care less about that. But it's really about the specific individuals, because we're at a moment in time where we will have new defining exceptional firms, but they're going to look different and have a different approach. That's the only way this thing works. They're not just going to be fighting for consensus. They're going to be trying to define what consensus will be over the next 10 years. So that one, I would tell them, be careful with, unless I have some real insider knowledge of people that I think are just exceptional.
Yeah.
And then, cut publics and private credit and search funds and everything else.
I was pretty shocked recently. I saw that there was a Vanguard interview I listened to where they were recommending 20% of your equities you consider putting into private equity, including venture. And that was much higher than I would have been expecting from a Vanguard representative. So it does feel like more and more we're going to be getting these questions from our friends who have been taking more conservative paths on what is the right way to participate in venture capital specifically. And like, you're not going to get things like, vintage diversification, et cetera, if you're making one bet out the gate. But I think maybe it's to your point on what are your expected outcomes, where if this is one bet you can make that's going to 0 or going to 10x, cool, if you're happy with that. Or, are you looking for something that feels more like, consistent deliverable returns, more like a public ETF or something?
Yeah. I think you should be making decisions. Friends should be making decisions based on what their risk profile is, how they're, diversifying with respects to the asset class. I'm actually not that surprised by the 20% because within private equity or privates is like so much stuff, right?
Totally.
It's private credit that I make fun of all the time. Private equity, there's more permanent capital for all these like services and family businesses that are happening. And that's probably going to be a majority of it. And venture would be, I'm sure, not more than 5%
Totally
of your portfolio. But yes, I think we're moving to this again because companies are staying private longer. And then the last question that I've just been kind of thinking about is, everyone's talking about, we're clearly in a technological shift. We're in a geopolitical shift too, economic shift. But staying on the technological shift with AI, I've been thinking about, in a world where we have these larger venture players that kind of can determine what is consensus fast of deals. And again, my view of venture is like, you want to find non-consensus today that's consensus tomorrow. Is that going to change the archetype? Everything going on with AI, is that going to change the archetype of the outlier founder?
Oh, for sure. I think my favorite sort of archetype is the exceptionally non-harried, straightforward, thoughtful. The guy who's actually seems like he's got a lot of free time. Founder. I would say Zoom's founder. I'd liken my buddy Dimitri of Modern Treasury to this. It's like nothing flaps them. I think I don't want any more of these like energetic party planner founders in an AI era. I'm looking for people who are way more methodical, because I think I think it's an era that's going to be all about process.
Who can bridge worlds, right? Like if you're on the coast in San Francisco and you're selling into Midwest companies, who can do that well and connect? Who can hire great talent that can be creative and thrive? I know we think that they're going to have these worlds of companies that are really big, efficient, and only have 3 people working at them. I don't think so. And so you're going to need, I think we're in a vacuum currently of leadership, and that's across the board and everything. And so I think these new archetypes of founders are going to be amazing, amazing leaders of women and men. So that's what I'm kind of looking for. Yes, they're going to be technical, but they're going to understand the human experience really well. Because that's what you want when you have like a shift in technology and you upgrade. So
I think that's a great point, that these people are going to have high EQ. Because that's going to be a distinctive factor. Okay, and I have one more thing for us to debate. Do you rock your OG Swimming with Allocators hat more, or the new latest Swimming with Allocators hat?
wait, which one is this?
You're wearing the new one.
Oh, okay. Well, that's the one I wear.
What's the font? Wait, what's the font? You're small. Oh yeah, that's the new one.
Cool. Well, that's the one I wear. That's that. So everybody should go get it.
Totally. It's swimmingwithallocators.com. You can go get a hat that says that you are a allocator or swimming with us.
Some of the allocators that was quoted on Bloomberg. So
yeah, fancy. A lot of people listen to us, not just you. That's proof is in the pudding. Audience member, thank you.
yes, our one audience member. Now, moving to our last section, the Q, which is questions from our audience or just questions we have for each other. So first question we have is, would you join a new climate-focused fund today, Alexa?
Would I join a new climate fund? I can't say I would recommend that. I think it would be worth joining old climate funds. Like anything that has history and some lessons learned of investing in spaces that have come in and out of favor.
Quick follow to that. Start, bench, cut. Climate fund, crypto fund, direct to consumer fund.
Oof, rough. Run! Climate. I mean, we haven't solved it yet. Like crypto, I'm still waiting for it to solve something. And besides just being a multi-level marketing scheme, question from the audience: where's your next event, and how do I get invited?
So our next event, we're working on that, but we got a couple of things likely happening in July, August, and maybe September. And the cities we're looking at will likely be San Francisco and New York. But if you, and how you get invited is we primarily invite LPs that are located in that city. We're doing a live podcast recording that I'll be in Chicago for their Chicago Tech Week. And so that's on all my socials. And next question that this is just from me. Alexa, you had a baby.
Yeah, I had a baby. That's one reason why Earnest has been doing a bunch of awesome interviews solo. Thank you, Earnest. Keeping us swimming.
Keeping us swimming. That's the next t-shirt. Keeping us swimming.
This is like such a me story. I failed my lifeguard exam, the written portion. I passed the swimming part. And so I like fully legally blonded my way to being a lifeguard. I like massaged the quiz to make sure that I still got a passing grade.
We should just have one DDQ where we just tell stories of that are venture related, some that aren't. Just like some people.
If you're drowning, I can pull you out of the pool, but like have someone else do the CPR is the lesson learned.
Okay. Especially if they ask, it's like, have you passed the written portion? That's funny. Well, we're ending DDQ, and but like most DDQs, even after those 100 questions, you're like, I think I have some additional information. It might not be in the DDQ, but it's definitely something I can't stop thinking about. So there's a scene in American Psycho. Yes, I'm referencing American Psycho, where Patrick Bateman is in a cab with his girlfriend yelling, "I just want to fit in." That line hits harder in venture than most people want to admit, because right now, everyone's acting like they just want to fit in. Founders pitch me like they read the same memo. GPs build decks that feel like ChatGPT wrote them. Even LPs, they're rotating between the same 8 funds like it's a Coachella headliner. And look, I get it. Things are chaotic right now. It's 47 senior year. AGMs feel like Met Gala plus due diligence. Firms are turning into RIAs. AI is flattening knowledge access. Retail money is leaking into alternatives. And first-time fund managers, they've only raised $1 billion this year and not looking like they're going to get back to where they were last year with $6 billion. So yeah, I understand the instinct to not rock the boat. But here's the thing. This market doesn't reward safety. It never has. Venture capital is supposed to be the industry that bets on non-consensus truths. So why is everyone acting like they're trying to get promoted at McKinsey? Differentiation can't be just branding. It has to be earned, lived, brick by brick. The best GPs right now are asking themselves, where's the world actually going? What do I believe that the market doesn't yet? And what am I willing to risk to prove it? You know what I'm thinking about? Where business, culture, and demographics are colliding, where generational shifts will require a new style of leadership, where the best founders may no longer be the smartest in the room, but the most tuned into signals that others ignore. Differentiation today means saying something bold, not safe, building firms that look more like movements than models, and maybe not fitting in at all. Because if we all just keep trying to fit in, the future's going to look a whole lot like the past. And I don't know about you, but I'm not in this game to replay history. I'm here to write the next playbook. And that's our DDQ. Thanks everybody for listening. Thanks for your support.
See you later, allocator.
After Portfolio Tile, investing with a smile.